Neuberger, Berman. Welcome to the SIBO.
Oh, thank you.
Well, I guess let's start out at 8:30 Eastern. What'd you think of today's CPI and initial jobless claims?
It's a disappointing number, and it's a stronger number that's going to cause probably a little bit of consternation for the Fed. And I think the biggest takeaway is, the headline number, 3.3, we're just having slower progress towards the Fed objective. But then you look internally to the number, we're starting to see a little bit of upward pressure on goods prices. And then the biggest one is that core services ex shelter. That's an inflation rate that's still right around 5%. And I think it just is speaking to the next 12 months, getting more progress on inflation. It's just going to be harder, and that's going to put the Fed in a little bit more of a bind.
Now, Helene hit on the 26th. I doubt if much of that was in this number. Wouldn't you agree with that?
Yeah, I think that's probably something that we'll see over the next month. And like obviously the hurricanes are going to impact some of the job data, but it's hard not to reach the conclusion. We looked at last payroll number, we were talking about this. The economy's in pretty good shape, and it's now being coupled with inflation. It's a little harder for it to get back down to the Fed's target.
Now, many have talked today about, hey, if we see weather-related inflation, you can't adjust monetary policy to that, and I would agree with that. It hasn't shown up yet, but if the Fed has already committed that they believe inflation is slayed, they've switched to labor, when those numbers come up, whether they should be that relevant or not, while they're already in the box with hot inflation, that's not going to be an easy issue to deal with, is it?
No, I think, we've been talking about this, right? The bond market is priced already for the Fed to take the policy rate down to the low threes.
Well, not anymore much.
It's around 3.3, 3.4 is where we're going to end up.
I guess depending on how you look at the yield curve.
Yeah, how you look at it a little bit. But there's still, we can agree, there's a lot of easing still priced in. And I think it's unlikely, and we think it's unlikely, this is going to be a straight line easing cycle for the Fed. And that will, whether it's the next few months or early next year, there's probably going to be a decision point where the Fed will think about taking a pause on this cycle.
Now, having said that, and I'm listening to you saying this, October 1st, if you look at every session, second, third, all the way on, 10s, 20s, 30s have closed higher in yield every day. And every single session, today being the 7th, they've had a higher yield than the previous day's highs. What do you think the market's trying to say here?
I think there are two things. One is, the data, more the inflation, what it means for the Fed. And the second's the election. I think the market is now starting to refocus on fiscal and what that's going to mean and some of the impact it could have on long end yields.
Yeah, because neither of the candidates is focusing on fiscal, that's for sure. Ashok, thank you for joining me today.